Over the past few weeks, we have seen a lot of volatility across markets. Stocks have sold off sharply, crypto has corrected, and even gold has pulled back. Naturally, the question many investors are asking is, are we in the middle of a market crash, or are we simply setting up for another leg higher? In this video, I'm not here to tell you whether the market is bullish or bearish. Instead, we'll look at the key data points that actually matter, so you can understand the levers that are driving the markets right now. Hi, I'm CY, and on this channel, I break down complex finance topics and deep dive on macro. If you enjoy this type of content, please consider subscribing to my channel. Now, let's dive in. To understand what is happening right now, let's start with the economy. Ultimately, the market is a function of economic health, growth, jobs, and spending. If we look at US GDP, the data suggests the economy is holding up reasonably well. We are not seeing recession-level conditions at this point. More importantly, major institutions like Goldman suggest GDP growth will outperform estimates in 2026. That implies that the economy may stabilize and recover rather than deteriorate further. That said, GDP is a lagging indicator. It tells us where the economy has been, not where it's going to go next. To understand the direction from here, we need to look at the more forward-looking data. And this brings us to PMI, which gives us a real-time read on economic activity. Right now, we are seeing a clear split. Manufacturing PMI remains below 50, which indicates a contraction. That part of the economy is still under pressure. However, services PMI, which represents a much larger portion of the US economy, remains above 50. This tells us that while manufacturing is weak, overall economic activity has not broken down. And because the US is primarily a service-driven economy, this is an important stabilizing factor. It suggests that we are dealing with slower growth rather than an outright economic collapse. Now, let's look into CPI, which is the third chart. And this brings us to the Fed dual mandate, which is stable prices and low unemployment. Here's the friction point. CPI, or inflation, is still hovering above the 2% target that Fed set. It's sticky, and because of this, the Fed is changing its tune. The easy cuts the market price in for early 2026 are being debated. And this matters a lot because inflation and unemployment drives Fed's decision on interest rates, which leads us to the fourth chart on interest rates. Historically, low interest rates tend to be supportive for stocks, especially when the economy is still growing. And that's why the market often rally where rate cuts are expected. However, because inflation remains elevated, the Fed has been slower to cut rates. This has contributed to recent market weakness and increased volatility. There is also uncertainty around future Fed leadership. President Trump has expressed a clear preference for lower rates, and potential nominees like Kevin Walsh are seen as more open to easing policy. That said, even a more accommodative Fed is unlikely to act aggressively if inflation remains sticky. This policy uncertainty is something markets are still trying to price in. And finally, we come to liquidity, which is arguably the most important driver of markets. Interest rates are the price of money, but liquidity, often measured through global M2, represents the supply of money in the system. Historically, expanding liquidity has been supportive for equities and other risk assets. And at the moment, global liquidity is rising. Not rapidly, but it is moving higher. This reduces the likelihood of a sharp market collapse. However, there is a potential risk. Some policymakers have expressed a desire for a small central bank balance sheet. If liquidity tightens while rates remain elevated, that could limit upside for markets, which is partly the reason why markets are panicking right now. So, where does that leave us? The economy is doing okay, it is not collapsing, but the feel for the next rally, rate cuts and liquidity, is currently at a tug of war. Liquidity is rising slowly, which is the primary driver, but the policy shift under potential new Fed chair creates a range of outcomes we haven't seen in years. Likewise, economy is not breaking, which makes scenario for a fast balance sheet expansion to be lower. It will likely to stay sideways in my opinion, unless something breaks. Trump wants a strong economy as his scoreboard, but the balance hangs on how the new Fed handles the balance sheet. We are not in a crash, we are in the middle zone. Stay patient, watch the M2, and don't let the headlines distract you from the framework. If you enjoyed this style of video, please subscribe to my channel, and I'll see you in the next one.